Hey guys, it's about this time of the year that I always have an educated guess in terms of what's going to happen to the housing market and to mortgage interest rates. Let's start off with what the hell is going on with this housing market. Look, it's not first home buyers. The reality is that the first home buyer market is driven by affordability. Bank credit criteria really hasn't loosened. Most of the statistics are pointing to the fact that first home buyers are actually still operating within the LVR restriction limits. So even if the Reserve Bank does tighten up on LVRs, it's not really going to impact on that part of the market. So if you're a first home buyer, nothing really to worry about other than these crazy house prices and everyone else trying to get in front of you. And I know that's hard. What's driving this market is next home buyers. We've never really talked about them. It's always first home buyers and property investors, but this is really a function of COVID. It's a function of people spending a lot more time in their homes and their homes becoming more important and then wanting to do more. You know, if you want signs of that, look at Bunnings and Mitre 10. People are spending a huge amount of money on doing their houses up at the moment. They're doing that, but they're also upgrading. So we're seeing a lot of people coming in who are wanting to use the equity that they've built up in their property over the last 5 to 10 years to buy something better, get themselves into a better suburb, a bigger house. Maybe they're having more kids, they don't want to renovate, they want to buy something else. And of course, this is just pushing up the whole market. So that's basically what's happening with house prices. What could slow that down? Well, look, the Reserve Bank is going to reintroduce LVR restrictions. I think that's pretty much a certain thing. I think that will happen quite fast. I think that will put a bit of pressure on the property investment market in particular. You can expect to see that 70% LVR restriction back in place, I would suggest, before Christmas. That'll slow that down a bit. That'll slow down maybe a bit of bridging finance, which could pull back a little bit on those people trying to upgrade and certainly trying to hold on to their existing property as a rental. For first home buyers, I wouldn't be too concerned about it. I think your market's pretty much going to stay the way that it is. If we look forward to next year, there's still a lot of uncertainty in the world. I think locally it's getting more and more settled. We've got a stable government, we've got a clear government. Things look pretty good here, but you know that it could get a bit worse next year. Tourism sector still hasn't really felt the full brunt of COVID yet, and I think there'll be a lot of businesses that don't survive past the summer. They certainly couldn't do another winter without tourists. So you know, there's still some things in this economy that may be, you know, are a little bit challenging, but offshore we've got Trump, we've got US elections, we've got a global economy that's really struggling with COVID. We don't have a vaccine yet. There's still talk that it's coming and maybe it's imminent, but who knows, it could still be another year. So I think there's certainly a risk to share markets globally. And you could see some sort of market correction there at any time, anyone's guess, but these sort of things could hit confidence, and if they hit confidence, that could flow through into the housing market. Beyond that, things look pretty solid. You know, I'm on record as saying that by 2030, so another sort of 8 years away, 9 years away, the average house price in New Zealand will be $1 million. And I still stand by that. I don't think that's going to change. So my long-term view of this is house prices are going up, fundamentally driven by low interest rates. You know, when you've got interest rates around sort of 2 to 2.5%, that's going to translate into house prices. There's some really good blog posts on our website about that. Take a read, and they're a bit complicated, but they basically explain pretty much why house prices will head to $1 million. So if you think of houses, KiwiSaver, same sort of idea, right? You don't get caught up in the nuances of what's happening in short periods of time. You kind of look through that and you just have the confidence that, you know, your KiwiSaver balance will go up in the long run. And I think you can apply the same logic to housing, which is house prices will go up. They might go up and down a little bit, and they might be a bit volatile, and there'll be times in the market where it's a bit scary and people will be saying sell, and then other times they'll be like, oh, you have to buy or you'll miss out. You're going to have all of that short-term volatility and good news and bad news, but if you take a long-term view on it, I feel very confident with a very low interest rate environment that you're going to see gradual increase in house prices over time. Let's talk about interest rates. So what's going to happen with mortgage rates? You know, we had that kind of crazy 199 special come out from Heartland Bank. I've got a blog post up on that at the moment. It's not very complimentary to poor Heartland Bank, but I think it's accurate. And it sort of goes to explain that, look, You can put a lipstick on a pig, it's still a pig. At the end of the day, rates are going to drop, and I think there's a pretty broad consensus on that with the amount of money that's getting printed and the Reserve Bank putting in a funding for lenders program that's going to drop bank funding costs. That will eventually pass through into borrowing rates, but I don't really expect to see that until probably maybe partway through next year. Maybe April, May, June. Certainly not this early. In terms of that Heartland special, no cashbacks, very limited offer. They're not really a mortgage bank. I think their total mortgage book at the moment is a little over $40 million, which gives them 0.01% of 1%. It's a very small market share. They're about a 15th of the size of the Nelson Building Society, to give you an example. So you can get awfully excited about some headlines, but the reality is quite different. And interestingly enough, if you look at the offers that we're getting out of the big banks at the moment, we're largely getting rates around 2.45, but we're also getting 50 basis points or 0.5% cash back, which if you add it into the rate equates to a 1-year rate of 1.85 to 1.9. So the reality is all of our major banks are putting honeymoon or first year offers into market that are sub 2 already. It's just not as visible because some of that's coming as cashbacks. So next year I do expect to see rates go lower. I wouldn't sit on floating in the interim. Floating rates are too expensive to sit on for any extended period of time. For now, I would be fixing for a year, take advantage of these really low rates, and just know that in a year's time when that matures, you're going to get even lower rates. And that's got to be something good to look forward to. So hopefully, look, there's a bit of a prognosis of where the market's at. Talk to you again soon. Cheers.